Growthpoint Properties is an ASX-listed landlord investing in Australian office, industrial and retail real property with a portfolio currently worth $2.4 billion. The company recently was included in the S&P ASX 200 index. I'm Carolyn Herbert, and joining me at the CEO sessions in Sydney is Growthpoint's Managing Director Timothy Collyer. Tim, welcome to FNN.
Thank you, Carolyn.
Tim, can you start by giving us an introduction to Growthpoint Properties Australia?
Certainly. Well, Growthpoint is listed on the ASX. It has a market capitalisation of about $1.8 billion. As you said in your introduction, we own commercial and industrial property around the country. We have 54 properties valued at $2.4 billion. We came into being in 2009 when Growthpoint Properties of South Africa first invested and recapitalised a listed company. And that began Growthpoint Properties in Australia. So since that time, we have, early in the days, we restructured, recapitalised it, and essentially started the business here in Australia. And we've built the assets from about $650 million in that time up to the $2.4 billion. Our simple philosophy is we're a landlord of quality commercial real estate around the country. And we receive the rental income from the properties as our primary source of income. We pay the bank some interest, of course. We pay some management expenses, and the balance goes to investors.
The company has just released its full year results for FY2015. What were the highlights?
We believe that it's been our best year to date. All facets of the business are performing very well. We had a statutory profit of $283 million. And part of that statutory profit was a large increase in property values of about $183 million. So we had good revaluation gains within the result. Our distribution was achieved, our guidance, our earnings were strong, 6% up on the prior year. And of course, our returns on the share market were very good. The total return to security holders for the 12 months was 36.4%. We were one of the better performing A-REITs over the last 12 months. And our return on equity, balance sheet return, was very strong at 23.9%. So all in all, a most pleasing result for our security holders.
And what about the company's gearing and average term of its debt? How has this changed from the previous period?
Yes, over the 6 years we've been operating, we have gradually reduced our gearing. So we now have a target range of 35 to 45% gearing, and at balance date at June 30, our gearing was at 37%. We have debt from banks, and we also, during the year, obtained a credit rating from Moody's. So we did our first debt capital markets issuance. So at June 30, we have an average term for our debt of about 4.7 years.
And looking at Growthpoint's property portfolio, what's the split between office, industrial and retail?
Yes, well, we have a mandate to invest in all those sectors. Currently, we haven't invested in retail property. So currently, we have about 50% in the office sector and about 50% in the industrial sector. So typically CBD and suburban office buildings, and also on the industrial side, large distribution centres.
So how are they performing, and what's the focus?
The portfolio is performing very well. We have 97% occupancy. We have a long-term average lease of 6.7 years. Embedded in our properties, we have rental increases annually of around 3%, so our income is growing all the time. And of course, we have good tenants, such as the Commonwealth Government. Woolworths is our major tenant, GE, the State Government of New South Wales. So we're very well placed. We have low expiries, lease expiries over the next couple of years, so our income is fairly stable. So we are well placed in this market at this point in time.
And Tim, where are your properties located?
Principally along the eastern seaboard. We have about 82% of our portfolio in Brisbane, Melbourne and Sydney, roughly a third in Brisbane and Melbourne, and a bit over 20% in New South Wales. We would like to increase our weighting to New South Wales. We believe the economy is a good one at the moment, and over the next period ahead we'll be endeavouring to increase our New South Wales presence.
So what do you look for when acquiring a property, and what's your acquisition strategy going forward?
Well, firstly, we look at the property. The property has to be a good one. So we typically go for modern properties where there's low capital expenditure. Obviously, we look at the location of the property, the tenant, the growth in the income, and these types of factors. So firstly, we have to be satisfied it's a good property. Then secondary, we look at how does this fit in with the growth portfolio, a Growthpoint portfolio. Do we have too many properties in that area? Are we already exposed to that tenant? So it needs to provide some diversification and betterment of the portfolio. And then of course we look, how do we fund that acquisition? So we look at our debt and our equity to fund it. And overall, if we're bettering the group, bettering the portfolio, then we proceed with an acquisition.
The company has implemented a 100% pure landlord strategy. Why have you decided on this approach?
Yes, so as you say, we are a landlord with 100% of our income coming from leases. It's probably more of a traditional approach. We don't have businesses that develop industrial or residential. We're not in retirement. We're not in funds management. It's a fairly simple and transparent model. So in putting that together, we believe it's lower risk than other things. So we're not exposed to development cycles, and the source of the income is leases, which are typically long-term from quality tenants. So it's a model we understand, and as we own all the properties, Growthpoint itself owns all our properties, we can concentrate on just providing services to tenants and renewing leases.
And finally, Tim, what's your outlook for FY2016?
We have a positive outlook. As I said at the start, we're well placed going into 2016. We'll be looking to acquire more properties, hopefully accretively, although opportunities are very difficult to attain at the moment. There is a strong market. We look to go to the debt capital markets for some more debt. We will consider selective disposals of assets that don't meet our long-term requirements. And of course, we have our guidance out there at the moment of 21.3 cents earnings and a distribution of 20.5. So that's a 4% growth on the previous year. So all in all, we're well placed, and we look forward to another successful 2016.
Tim Collyer, thanks for the update on Growthpoint Properties.
Great, thank you.